we talked at the top of the show about the ideas that consume your time. Well, how do you know when one of those ideas has the right place at the right time to buy the stock? Yeah, that's what I'm thinking about. I'm thinking about the top of the show, and I'm thinking about Spotify. I don't know if you know Spotify, but it's the world's largest music streaming service, with a stock that came public a little more than a year and a half ago. After initially roaring right out of the gate, the stock rolled over at the end of last year, along with everything else, and it never really recovered from that meltdown. It was almost as if its time had not yet come, but when it opened, everyone was so darn excited, including me. On Monday, though, at last, Spotify reported a fantastic quarter, and its stock surged nearly $20, or 16% in a single day. Maybe some vindication for me? So is Spotify an idea whose time has come? Maybe, but as someone who started recommending this thing pretty much the moment it came public, well, let me just tell you, I've been burned every single time that I have said it's the right thing to buy. Every time I thought we had a sustainable rally, and I was wrong. Every time it gained momentum, it swiftly lost that momentum. Even when the company reported what I thought were good numbers in the past, Wall Street would always find something to nitpick about, and then the stock would get hit. But you know what? This time was different. There was nothing to nitpick with this quarter, and it feels like the market's finally giving Spotify the credit it deserves. But will the newfound love for this stock last? I know when I spoke with them on Monday, I sensed that maybe it's for real this time, but I've been wrong. But let me tell you why I think there'll be more upside. First, you need to understand that Spotify is a terrific concept. They give away their huge library of music content if you're willing to listen to ads. But you know what? You can pay up for an ad-free experience, and there's a great migration that comes from the advertising people to the ad-free. The company's got 248 million monthly active users, which includes 113 million paying subscribers. That's a unique club, the 100 million plus club. It's growing like a weed and has totally transformed the music industry. However, for most of its existence as a publicly traded company, Spotify struggled to find its groove. They've now reported 7 quarters since the public listing in April of 2018, and while management's delivered some impressive numbers, 5 outright revenue beats and just 2 very small misses, even positive earnings reports have failed to become positive catalysts for the stock, as you can tell from this incredible depiction, until 2 days ago. All right, what was Spotify's problem? Why did people not like it? Well, there are a couple of issues we can go over. For one thing, it's never been crystal clear exactly which metrics investors should care about the most. Remember at the top of the show, I talked about time and I talked about government. What if those are metrics that we're trying to factor in? What were the factors that you needed to know here? Was it total monthly average users? Was it paid subscribers? Was it revenue? See, there was no consensus on Wall Street. So whenever Spotify reported an upside surprise with some hair on it, there's always someone willing to argue that the negatives outweighed the positives. Second, Spotify's a European company, and it gets a huge chunk of its revenues from the United States, though. So you have these ridiculous currency fluctuations, and they often make it very difficult to interpret the numbers. For example, the last time they reported 3 months ago, the sales and earnings were fantastic, but the paid subscriber numbers came in weaker than expected. Some analysts upgraded the stock and raised the price targets, but others told you the paid subscriber forecast was all that mattered and downgraded the stock. Yeah, at the same time, we had upgrades and downgrades. Always a curious situation. So ended up that, well, it got hit on the news. But then it rallied to its year-to-date highs a couple of days later. Pure confusion. Third and most important, Spotify's management is incredibly non-promotional. The team, led by the straight-shooting chairman and CEO, Daniel Ek, has developed a reputation for giving conservative guidance on their conference calls. Now, personally, this is one of the things I loved about Spotify. I prefer executives who practice the art of UPOD, under-promise and over-deliver, to executives who overpromise and underdeliver and really break our hearts. Unfortunately, there were times when the company would report stellar results, but then management's forecast sounded tepid, and investors gave up on the stock because of it. So I want to use a technical term about what happened on his conference call so you really understand. No mojo. Meanwhile, not everyone was confident in management's long-term strategy. At the beginning of the year, Spotify announced that it was making a major move into podcasting. I thought this was brilliant, too. This is another mistake I made. They acquired Gimlet Media for content and Anchor, a platform that helps people create podcasts. And look, I didn't cheer it just because it happens to be in Brooklyn, about 5 blocks from me. This move was greeted with skepticism by others, and the bears only got more hammer when Apple told us they were getting into the same business over the summer. Now, all along, I know I've been positive on Spotify, except during a moment of temporary weakness when the stock was hit by a savage rotation out of growth and into value. The bull thesis is simple. Spotify is a huge beneficiary from the rise of the subscription economy. These days, consumers don't really care about ownership anymore. They're happy to pay for a monthly subscription service that gives them access to a huge library of content at a bargain basement price. Plus, Spotify's always had impressive numbers. It's been very frustrating to watch the stock flounder, even as they kept delivering solid results. Over the summer, though, investors started fretting that the company was experiencing a subscriber growth shortfall. In August, the company extended their free trial period from 1 month to 3 months, which made people worry that the streaming music space must be getting more competitive. So when Spotify reported that fabulous quarter on Monday, thank heavens. Well, they didn't just deliver better than expected numbers. They also put many of these concerns to bed. They finally delivered exactly what I thought that they were going to deliver, and then some. The company posted terrific, better than expected sales, up 28% year over year. Remember, this is big numbers, people. They generated 54 million euro operating profit. Street was looking for 30 million euro loss. Spotify's monthly average users grew by 30% to 248 million. That's 5 million more than the analysts expected. That includes higher than anticipated premium subscribers at 113 million, up 31% year over year, and much higher than expected ad-supported users, up 29%. Even though management once again gave conservative guidance, at least at the time it was in line with Wall Street's expectations, they even raised their monthly average user forecast for the next quarter. There was very little to quibble about. When you drill down, it is clear that Spotify, it is firing on all cylinders. There is no bear case that I can find now. Their international growth was tremendous. Their business in Latin America, wow, I couldn't believe how strong. Southeast Asia, I asked the CFO about it, accelerated dramatically. India outperforming management's forecast by 30%. Spotify's been fiddling with its platform to improve subscriber retention. These changes are clearly working. How about the podcast business? Wall Street's been so skeptical. Spotify pointed out they're seeing exponential growth in podcast hours streamed, up 39% versus last quarter. Not last year, last quarter. Management adds that, and I quote, for music listeners who do engage in podcasts, we are seeing increased engagement and increased conversion from ad-supported to premium, end quote. That's the holy grail. Then they continue, quote, some of the increases are extraordinary, almost too good to be true, end quote. Holy cow. Finally, Spotify gave us more color on their two-sided marketplace initiative. They want to give up-and-coming musicians tools to help connect with an audience and develop their careers. Isn't that great? This could be a huge source of revenue, too, down the line. Management told us they'll have more financial details the next time they report. No wonder the stock caught fire on the news. The numbers were almost universally better than expected. The much-doubted push into podcasts is paying off in a major way. People love podcasts. We all know there's positive catalyst down the road thanks to the two-sided marketplace initiative. So could this at last be the beginning of a longer-term rally for Spotify that I thought from the beginning but have been wrong about? It wouldn't be the first newly public company that took a long time to find its groove. Hey, by the way, we saw the same thing happen with two of my absolute favorites in 2016 and 17, Okta and Coupa. It took a little while. Oh, but once they caught fire, wow. And you know what? And the same thing goes for Facebook. Big swoon, then monster rally. But once they found their footing, they gave you spectacular long-term gains. Oh, by the way, Netflix had its troubles, too, before it took the bull by the horns. You know who was one of the architects of that company's strategy of matching your taste with your films in a predictive artificial intelligence fashion? The retiring Spotify CFO, Barry McCarthy, whom I interviewed on Monday. Oh, he will most certainly be missed. And I always think of him when we use Spotify at our restaurants. And it mind reads what our collective customers want, the bottom line. I think Spotify will be just fine. I think it's terrific. Company just reported a game changer of a quarter. And after that rally, the stock's basically back to where it was when it came public in a direct listing last year. And you know what? I know this looks steep. You ain't seen nothing yet. Bill in Georgia. Bill.
Hello, this is Bill in Georgia. Jim, I watched Broken Daily out for many years. I bought Roku and had a 20% gain approximately. Now, I held the stock, it dropped. Now I have a 6 to 7% loss. Should I hold or sell?
This is a wild one, Roku. Every time you see a new system come out, a new, David Faber with an unbelievable interview about Time Warner and their HBO on the go. What happens is people buy Roku. And so I have to tell you, sir, I don't think that one's done. I think that one can still go higher. All right, this could be the beginning of a long-term rally in Spotify. I'm serious. It may just, I got it wrong again. I've said that 5 times. I like to say when I got it wrong because I like to also say when I got it right, like with Apple, like with Facebook. Okay, there's much more Mad Money ahead. Trex has been on fire. There's another one I've liked. A chair for so far this year. But its recent earnings miss, they gave you a red flag in their own conference call. I'm going to sit down with the CEO to find out what's on deck for the company going forward. Then, it's a group of stocks priced for total imperfection. I'm going to reveal what they are and what you should do with them. And, of course, rapid fire. Yes, lightning round. So stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.